Hello everyone and welcome back to the world of fixed incomes and derivatives. Now this video is specifically designed for CFA level 2 students and the topic that I am going to pick could be classified definitely under the head fixed income, but basically it's a topic with the title derivatives. So I would have just commonly included in both of these subjects. So basically, as per your institute, it has been classified under the head fixed income. So the topic that I am going to talk about is credit derivatives. Now let me remind you, if you are watching my videos for the first time and if you are new to this channel, one humble request: don't forget the name of the channel and don't even forget to subscribe, and most importantly hit this bell icon so that you are always posted with all the upcoming videos. In this channel you will be finding a lot of stuff for CA, CMA and CFA level 1 and 2 students. So let me not take any more time and get back to the subject, credit derivatives. So if you analyze what is a derivative contract, the most important feature in the meaning of derivative, that it is a contract that derives its value from the underlying. Now we have learned in earlier classes of derivatives that within a derivative contract, an underlying component could be a stock, could be any other security, could be currency, could be a commodity, could be even index, or could be interest rates. So we have stock derivatives, we have currency derivatives, we have interest rate derivatives. What if the underlying is none of these, but the underlying is credit? It becomes a credit derivative. That means, to define it very clearly, you can say this term credit derivatives, it is combination of two words, credit and derivatives. It indicates a contract of derivative where the underlying is a credit. Now what does that mean, that underlying is a credit? What exactly do we mean? Basically, imagine that I am a lender, a money lender, a lending institution. I could be, lending money to various entities for earning some interest income. When I lend money, I definitely have risk. And what if the credit worthiness of the borrower gets impacted? What if the credit repayment capacity of the borrower gets impacted adversely and the borrower may not be in a position to pay back that amount to me? I will be at a risk definitely, and I want to cover my risk. So what happens? Say I approach an insurance company and I ask for an insurance cover. So what would happen? An insurance company will charge a premium to me and give me a protection. That fine, insurance company tells me that you don't worry, you just pay us this required amount of premium until the period of cover, and what we will do is, in case of the default made by borrower, we will compensate. We will pay you off that entire amount. Fine, I am protected. Now what happens? The contract between me and insurance company, if you observe closely, it is indeed a derivative, because just imagine if the credit worthiness of the borrower, if the credit rating of the borrower goes on changing, the amount of premium charged by this insurance company will also vary. That means the larger the risk involved, the higher the risk involved, the higher will be the premium charged. That means this contract has an underlying component as that credit, and that credit, which is the underlying component, changes in the value of that credit rating, or changes in that credit rating, changes in the credit worthiness of the borrower, is causing changes in the amount of premium that I have to pay to that insurance company. In that case, this is a derivative contract because it is deriving its value from the underlying. So I would want you all to please write up this definition of credit derivatives along with its detailed meaning, that credit derivatives is a summation of two terms, that is credit plus derivatives. Credit derivatives are such derivative contracts where the underlying is credit or a debt. So please write this much and then I take you ahead. Alright friends, once you have completed writing this heading and this definition, let me now take you to the next very important discussion. The financial products are subject to following two types of risks. Now, any financial product is generally associated with two typical types of risks. One is the market risk and another is the credit risk. So, let me give you an elaborate example to make you understand this. Suppose I am an institutional investor and I want to make a big chunk of investment in a particular bond issued by an incorporation. So, a corporate entity's bond I want to purchase in a big volume. So, I am a major investor and the counterparty becomes a major borrower. Now, the time when these bonds were issued to me, just imagine that time the prevailing interest rate in the market was 8% per annum, and therefore the coupon rate offered on such bonds was also 8% per annum. And when the bond is continuously paying me that coupon rate, because I am investor, somebody is borrower, that person who is borrower, that entity who is borrower is just giving me coupon payments on periodic basis at 8% per annum. Now, interest rate prevailing in the market will not remain static. Interest rate prevailing in the market will always undergo some or the other fluctuation. Just imagine that borrower and the investor, their position remains intact, but interest rate prevailing in the market, it has risen from 8% per annum to 10% per annum. Now what happens? I have invested a big amount of money in 8% bonds. That time interest rate was 8% when these bonds were issued. Say from the issue date, by now it's a span of 3 years already passed, and now the prevailing interest rate in the whole bond market or debt market has risen to 10% per annum. Now, if somebody has to borrow money, they are borrowing at 10%. If somebody is lending money, they are lending at 10%. But unfortunate thing that has happened to me, that when I invested, that time the rate was 8%, and now in spite of the market rate becoming 10%, I have to just receive interest at the contracted coupon rate of 8% only. Now this is definitely a loss to me. In simple words, what will happen? Because the prevailing interest rate in the bond market has risen to 10%, the investor's expectation, which investor I am talking about? The investors in the bond market or debt market, they have now increased expectation. They now expect 10% per annum. So now if 10% becomes my revised discounting rate, but the coupon payments that I am going to receive as an investor are just going to be at 8% of the nominal value, you know what will happen? When the discounting rate rises, the value of the investment, the value of the bond will fall. This is a loss of investment that I have made. Now, don't you agree that risk of interest rate fluctuation does exist? Yes, it definitely exists. Now, how can we manage that risk? We have learned concept of bond immunization under fixed income securities. We have learned concepts of interest rate derivatives, which are useful tools for managing the interest rate risk. That is why it comes under the domain of interest rate risk management. So, when there are interest rate fluctuations, it's basically a risk arising from the market. But when the borrower or the bond issuer has decline in the credit rating or credit worthiness, or I would say an impairment in the repayment capacity of the borrower, that is not market risk. That risk cannot be protected by market instruments. For example, for managing interest rate risks, I can have market instruments or instruments from derivative market which can give me some or the other kind of protection. But for anybody's credit decline or anybody's repayment capacity declining, market cannot provide me any protection. As a result, this risk which is arising because of decline in the repayment capacity of the borrower, where I am the money lender or I am the investor, that risk that I am assuming over here is basically the credit risk. So let us write this note about these two types of risks. Market risk: due to the adverse movement of the stock market, interest rates and foreign exchange rates, this kind of risk arises. And credit risk, also called counterparty or default risk, this risk involves non-fulfillment of obligation by the counterparty. Financial derivatives can be used to hedge the market risk, whereas credit derivatives emerged out to mitigate the credit risk. Accordingly, the credit derivative is a mechanism whereby the risk is transferred from the risk-averse investor to those who wish to assume the risk. Now, before you start writing this content, let me explain one more point which is given in that last paragraph over there. See what happens. Some time back I gave you an example of an insurance company. So I am making a contract with an insurance company where I was a money lender, where insurance company is providing me protection against the default made by the borrower. If the borrower has made any default, then the insurance company has promised me that it will compensate, and that compensation gives me a protection. Now basically I was having that credit risk. When I have lent money, I was having that credit risk, but my credit risk was taken over by that insurance company. So you know what I become? I become a risk-averse investor who is making some premium payment to get rid of that risk. On the other side, the insurance company is speculating. It is just expecting that maybe the credit risk doesn't exist at all. It is only the fear in the mind of the investor. It is the fear in the mind of the money lender that what if I don't get back my money? And that is where the money lender or the investor is trying to take a protection. So in that case, the money lender, that is me in the example, I become a risk-averse party who is trying to avoid risk by making some premium payment. The insurance company is seeking risk because it knows that with this kind of risk undertaken, it will not have any problem, because say out of 1,000 borrowers, 1 or 2 borrowers may make default, or some borrowers may make default. In that case, if the insurance company has sold protection to 1,000 such lenders or investors, in that case, out of 1,000, maybe a few contracts may have the claim raised by the investor or lender for the risk protection, but in all cases it may not happen, and that is the kind of business that insurance company is carrying out. So what I am going to do at a little later stage, one very important aspect of credit derivative, rather I would say one type of credit derivative which we call as credit default swap. I am going to introduce that term, credit default swap. And what I gave you initial example as an insurance thing, that insurance is as such not an insurance policy, or formally it is not called an insurance, that is called credit default swap in the field of finance. So we will be definitely discussing about the same at length, but let me first give you an opportunity to note down this whole thing quickly. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. A credit derivative is a contract whose value depends on the creditworthiness or a credit event experienced by the entity referenced in the contract. Now before we write anything further, let me just provide you some explanation at this point itself. Look into one thing. We are talking about a credit derivative where the underlying is basically a credit given to a counterparty. Now, if you could see, here there is an entity which is referred to as referenced entity. Now, which entity is a referenced entity? You should understand referenced entity is the primary borrower, and in that same paragraph you would find that the word credit event is given. What is that credit event? The credit event is basically a trigger point which causes a settlement position in the derivative contract. So basically it is the point of default made by the borrower. That means when the borrower makes a default, that is called the credit event. So let us focus on the next point over here. The next point over here, it says a credit derivative allows creditors to transfer to a third party the potential risk of the debtor defaulting in exchange for paying a fee known as the premium. A bank can use a credit derivative to transfer some or all of the credit risk of a loan to another party. In principle, credit derivatives are tools that enable banks to manage their portfolio of credit risks more efficiently. So quickly write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead, and now we talk about the most important term of our discussion over here, that will be credit default swaps. So let us first try to understand what exactly is a credit default swap. So you have three terms included in this title: credit, default and swap. So what exactly is this? If you can recall, while explaining you the initial part of credit derivatives, I told you, in fact I gave you an example of a money lender, an institution that is lending a huge sum of money to the counterparty, that is the borrower, and for protecting its risk against the default, the lending company has taken an insurance cover. That insurance cover, I told you that time, is formally and financial terms it is called credit default swap, CDS. So basically in a credit default swap there will be involvement of three parties. One that is the principal borrower, one that is the principal lender, that means one lending institution and one borrowing institution. The borrowing institution is referred to as reference entity, and that is basically the debtor in this whole arrangement. The counterparty, the creditor or the lender, is basically the party seeking protection against risk. Which risk? Not market risk, but risk of default. That is what we call as credit risk. And that is where the third party comes into picture, which is basically an insurance company. It need not necessarily be an insurance company. It basically could be any third party which has enough credit to compensate the principal lender. So the lender becomes the protection buyer, and the third party, the insurance company, becomes a protection seller. So there will be involvement of three parties. But more importantly, before I talk about those involvement of three parties, let us first focus more on these three terms, that is credit, default and swaps. I am sure by now you would have written this heading already, credit default swaps, in short identified as CDS. It is basically a group of three words. The first word is credit, the other word is default, and the third word over here is swaps. Which credit are we talking about? It is basically a loan or a debt given to the counterparty. What is default? Default is basically the credit event which arises as a non-payment by the borrower or a default made by borrower. So default resembles non-payment. And when we talk about swaps, swaps indicates exchange. But what are we trying to exchange? It is exchange of risk between the protection buyer and the protection seller. And now CDS can be defined as an insurance against the risk of default on a debt. So I want you people to write this whole stuff quickly and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and let us try to understand through an example. Imagine that this entity is a pension fund, and there is another entity, that is A incorporation, which is over here behaving like a borrower. This A incorporation has issued some bonds to the pension fund, where the pension fund, which is the lending institution, is purchasing or investing into these bonds, and therefore it becomes the lending entity. And let us assume that pension fund has lent $10 million to A incorporation, that is the borrower, and this is against the bond issued by A incorporation. Now we have a clear dimension of clear equation existing between the lender and the borrower, and now it is the lender, that is the pension fund, which is at the risk of default if any default could be arising from the side of borrower. That is the question on the creditworthiness of the borrower. Now for protection of its risk, it is basically approaching a third party, that could be an insurance company. Now what will be the connection between the pension fund and this insurance company? Pension fund will be paying certain premium to this insurance company, and insurance company is basically providing protection to this pension fund. Now before I take you any further, let me give you a more clear demonstration about this whole issue. You know, A incorporation has issued these bonds to pension fund. Suppose the pension fund is having a clear guideline given to it by its board that you are not supposed to make any bond investment where the rating of the bond is below AA category. So if the bond rating is below AA category, you are not supposed to make that investment. Now let us imagine that the bond issued by A incorporation was not of that credit grade. It was not a AA rated bond, say it was a BB rated bond, and pension fund was actually not supposed to make investment into that. But you know what? The riskier the bond is, the bond issuer will be providing a higher coupon rate on such bonds, so that the investor gets a little additional compensation for the risk that it is bearing. But here the pension fund was not in a position to make this lending at all, and therefore before even the lending takes place, that means before even the investment in these bonds take place, it has already approached the insurance company. This insurance company should be definitely having a very high credit rating equivalent to AA bonds, so that if that institution has enough credit rating, then and then only it can provide the protection to the pension fund. So this insurance company is kind of securing the payment or the repayment capacity of the borrower. In case of any default made by A incorporation in this example, it is the insurance company that is going to compensate. So what happens generally? As I said, suppose in the US bond market, if the interest rate prevailing is around 5.5% per annum in today's terms, and say A incorporation has issued a BB rated bond which is offering a 9% coupon payment. So what would this insurance company demand? It would say that, okay, you are having 9% of interest recovery. Out of that, you pass on 1.5% of interest on the principal amount borrowed on year to year basis for as long as you want the insurance cover. So what will be the thought process of pension fund? Pension fund over here, observe that it is earning 9% coupon rate on the $10 million loan which it has granted to A incorporation, and here the credit is protected by this insurance company, where it collects 9% coupon rate or coupon payments from A incorporation, and then the pension fund is passing on 1.5% out of that to the insurance company. So basically 1.5% of $10 million will be the annual premium that will be charged by the insurance company. So that becomes the income for the insurance company and expense for the pension fund, because pension fund is incurring this expense as premium to buy this protection. Suppose the life of this bond is 10 years. Then the original bond contract between the pension fund and A incorporation is a period of 10 years. But the insurance contract between the pension fund and the insurance company could be, say, annual contract. Now imagine what would happen. Initially the arrangement was done this way, that A incorporation is paying 9% coupon payments to the pension fund, and 9% is split into two parts, 1.5% and 7.5%. That 1.5% is passed on as premium to the insurance company, 7.5% net remains as income on that investment or on that lending by the pension fund. Now look at the point. Imagine what would happen after a few years. This A incorporation, it has a substantial decline in its creditworthiness. That means there is a credit risk which is found to increase. If the credit risk is rising, do you think from the fourth year, after observing the substantial increase in the credit risk, do you think after that third year period, this insurance company is all okay just to offer the same level of protection at just 1.5% interest? Absolutely not. It is not going to happen, because the risk has increased substantially. Insurance company would demand that, boss, now you pay me 2% because I am not okay with 1.5%. Now what is happening? This premium which is paid by the pension fund to the insurance company is the price of the protection, correct? That premium is the value of the derivative contract. So a credit default swap is an example of a derivative contract where the underlying for that derivative is a credit, and with the change in the credit rating, when the credit rating is declining and the risk is rising, the value of this default swap, that is credit default swap, is rising by increase of the premium demanded by the insurance company. That is why this suitably comes in the category of a derivative. It is a credit derivative where the underlying is a credit. So let me take you ahead in this and let us write some additional notes over here. Further, you need to write something about credit default swaps. It is a credit derivative that offers protection to the buyer against potential default and helps manage and transfer credit risk. Essentially, it is a contract between two parties where the buyer pays a premium to the seller in exchange for protection against the default of a specific credit instrument such as a bond or a loan. This financial tool has gained prominence for its ability to mitigate credit risk and its diverse applications across various sectors of the economy. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. Through a credit swap, a buyer can take risk control measures by shifting the risk to an insurance company in exchange for periodic payments. Just like an insurance policy, a CDS allows purchasers to buy protection against an unlikely event that may affect the investment. Credit default swaps are a type of insurance against default risk by a particular company. The company is called the reference entity and the default is called the credit event. It is a contract between two parties called protection buyer and protection seller. Under the contract, the protection buyer is compensated for any loss emanating from a credit event in a reference instrument. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. In return, the protection buyer makes periodic payments to the protection seller. In the event of a default, the buyer receives the face value of the bond or loan from the protection seller. From seller's perspective, CDS provides a source of easy money if there is no credit event. Assume that two parties A and B enter in a 5-year CDS. In this, A is the protection buyer and B is the protection seller. Let's assume that the notional principal is $100 million and the protection buyer agrees to pay 150 BPS, that is 150 basis points, which indicates 1.5% annually to the protection seller. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. If the reference entity does not default, the protection buyer keeps on paying 1.5% of $100 million, which is $1.5 million to the protection seller every year. On the contrary, if a credit event occurs, the protection buyer will be compensated fully by the protection seller. Hence, in case default takes place, there will be settlement, and in case no default takes place, no cash flow will accrue to the buyer and agreement is terminated. Amount of premium mainly depends on the price of the underlying, and especially when the credit risk is more. So please write up this as well and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and now we talk about the features of a credit default swaps. So please write the heading main features of CDS. CDS is a non-standardized private contract between the buyer and seller. So understand one thing, the nature of this contract is over the counter type. It is not exchange regulated. It is not available in the derivative market. They are normally not traded on any exchange and hence remain free from the regulations of governing body. The International Swap and Derivative Association, that is ISAD, publishes the guidelines and general rules used normally to carry out CDS contracts. CDS can be purchased from a third party to protect itself from the default of borrowers. The cost of premiums of CDS has a positive relationship with risk attached with loans. Therefore, higher the risk attached to bonds or loans, higher will be the premium or cost of CDS. So please write up this as well and then I take you ahead. Alright friends, after writing this, let us move ahead and now talk about the parties involved in a credit default swap. In a CDS, at least 3 parties are involved, which are as follows. The initial borrower, it is also called a reference entity, which are owing a loan or bond obligation. Then next one is the buyer, also called the investor, that is the buyer of protection. The buyer will make regular payment to the seller for protection from default or credit event of reference entity. And then third one is the seller. It is also called writer of the CDS and makes payment to buyer in the event of credit event of reference entity. It receives a regular payoff from the buyer of CDS in the form of premium. So please write up these 3 parties to a CDS and then I take you ahead. Alright friends, once you have completed writing this whole thing, let me bring back that same picture which I have shown you earlier. And earlier I did not give you time to note it down because it was basically incomplete. Here in the original example that I have given, A incorporation is basically the reference entity which is the primary borrower. The pension fund in that example is the protection buyer and the insurance company in that example is the protection seller. For your reference, you may write up this whole thing and once you write it up, we will be putting an end to this particular session.